Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good morning, everyone. I am Nick. In the past week, moving on to the markets, we've just had an incredibly exciting week. I suppose, first of all, the US inflation figures were probably much better than expected. And then China's inflation figures were much lower than expected. And of course, there's always a possibility that China will export disinflation to the rest of the world. So this disinflation rally has started. It's very exciting. The markets ready for the most of this year have been caught in limbo between two big risks. On the one side, the risk that inflation is going to be much higher than expected, and on the other hand, that the central bank tightening so far will tip economies into recession. So it's inflation on the one hand, recession on the other. At the moment, we've got this wonderful, almost a Goldilocks scenario where inflation's coming down, and yet there's no sign of recession on the horizon yet. In fact, economic momentum seems to be picking up, certainly in the Western economies, maybe not so much in China, but even in China, it's still motoring along quite nicely at about 5% GDP growth. So the last time we had this disinflation rally was in November last year, when there was a particularly good inflation reading in the US, and that sparked off a rally that continued really until February, before there was a bit of a consolidation, but it was a good 3 months or so. So I think we can look forward to that. So this morning, I'm going to be talking about the US inflation data, also some analysis from capital economics, observations from MRB, and then thoughts on artificial intelligence. So capital economics for a long time have said it's a transformative technology with significant economic and market implications. So I'm just going to drill down a little bit into that. And then a few observations from MRB just generally on the equity markets, and interesting comments on the UK, which I'm afraid are not very rosy. So we're going to begin now the US inflation data. I'm sure you're all well aware of it, but just to recap, core consumer prices month on month in June only increased by 0.2%. So if you annualize that, it's a very, very good rate. Headline CPI year on year dropped from 4% to 3%. That's a big decline. Of course, the inflation hawks will say that most of that is attributed to the base effect. So 12 months prior, that's to say June 2022, we had incredibly strong surge in energy prices, and that is obviously creating this lagged effect. Nonetheless, core inflation year on year also dropped, and core inflation strips out energy prices, food prices. That fell to a 20-month low of 4.8% from 5.3% the previous month. Capital economics have got this to say, and it's actually very encouraging about disinflation. Stripping out used vehicle prices, core goods prices have been broadly unchanged for the past 3 months, representing a sharp slowdown from the 0.3 to 0.4 monthly gains before that. It reflects the impact of easing supply shortages and post-COVID normalization of global shipping rates, with inventories now either back at normal levels or even elevated. The prices of household furnishings and other goods, new vehicles, IT goods and recreational goods are all in full retreat, with the 3-month annualized rates all negative. There is an easing in labour market conditions that is now having a marked impact on the most labour-sensitive sectors. The 3-month annualized CPI inflation rates for food away from home, recreational services, personal care services, and education and communication have all fallen sharply in the past 3 months. The Fed's latest beige book, so that's every 8 times a year they have an anecdotal summary from the different Federal Reserve Bank regions, and that most recent beige book acknowledged this week that, in inverted commas, wages continued to rise, but more moderately. Contacts in multiple districts reported that wage increases were returning to or nearing pre-pandemic levels. That's good news. We're moving now towards, before we move on to the AI story, I just want to mention a couple of observations from MRB. We know that MRB are the inflation hawks. They don't believe that inflation is going to return all the way back to 2%. They do agree that inflation is going to move down right through to the autumn, but by the end of the year, it's going to prove sticky once all those base effects are out of the way. Nonetheless, they are bullish over the short to medium term. They say the following: hopes that the rate hiking cycle in the US and elsewhere is nearly over could endure in the near run as measured developed market inflation eases into the autumn. In the near run, any relief in bond yields will be welcomed by equity and credit bulls. And on the recession topic, they're sticking to their guns. They still do not believe that recession is even likely over the next 6 to 12 months, especially if bond yields do not rise meaningfully and developed market central banks pause their hiking cycle, as many seem keen to do. Eventually, monetary conditions will have to become truly restrictive, but this is not yet on the horizon. So for the time being, it's off to the races. Now, moving on to AI, this is all from Capital Economics. Towards the end of June, we raised our 2-year forecast for the S&P 500, advising clients that we now expect the benchmark to rise by around 50% between now and the end of 2025. It's a bullish call and one that takes into account a US recession, albeit a mild and shallow one later this year. That reflects the potential of artificial intelligence. We feel that AI could shape everything from industrial processes to the US-China relationship in the coming decades, resulting in potentially momentous changes in economic outcomes. With positive implications for inflation, the growing use of AI and associated technologies in the workplace represents a rise in the global economy's supply potential. This in turn should be disinflationary. Expect a rising tide of productivity. And who will be the big winners? US equities appear well placed to benefit from an AI boom. We suspect that there is ample scope for US valuations to grow further over time. They could increase quite a long way still before approaching their dot-com or COVID era peaks. We forecast that the MSCI USA index will rise by more than 35% in 2024 and by nearly 20% in 2025. One downside risk is the possibility that the weight of big AI-linked companies will be reduced within the MSCI index, as is happening within the Nasdaq index. And while China's equities are lagging those in the US, they could eventually make up some lost ground. Chinese firms are arguably ahead in both technology and adoption in some key areas. So we're moving on to MRB, their outlook on equity markets. We've known for a long time their view. They feel that A, there will be no recession at least for the next 6 to 12 months, and B, although they believe and agree, like the consensus, that inflation will drop over the next few months, they believe that inflation thereafter will be a problem and leading to further interest rate hikes rather than the interest rate cuts that seems to be the consensus view. So first of all, the leading US economy has experienced resilience in employment and consumer spending, as well as renewed strength in the interest rate sensitive housing sector. These are not the sort of conditions one would expect if a recession was imminent. At this point, most have once again pushed out their recession call and expectations for deep rate cuts until 2024. However, it is important to remember the adage that economic expansions do not merely die of old age, they get killed. And the weapon, i.e. an overly restrictive cost of capital, is still lacking. So the MRB opinion is that by year end or early 2024, it will become apparent that underlying inflation is leveling off well above pre-pandemic levels. And this in turn should unnerve bond bulls and central banks. The strength in the Q3 Manpower Employment Survey is a clear warning that labour demand remains strong. But if we piece together the very bullish outlook from capital economics into 2024-2025 and the MRB view, we can expect at least a very good second half of the year for equity markets. Maybe not so for the UK market, and this is why. Relative growth, and this is still from MRB, relative growth in the UK will likely stay weaker compared to the US and the Euro area. The labour market has held up, but the growth outlook for the UK will be challenged in the coming months by higher interest rates, which will continue to weigh on economic sentiment as well as house prices. The UK economy is more vulnerable to higher interest rates compared to the US and Euro area, and that's because of much higher leverage in the household sectors and the business sectors. Really, all good on the local markets.
Hi, Nick, thank you very much for a very comprehensive overview, especially the AI side, which I liked. Locally, interesting things are happening this week, and Fitch also affirmed over the weekend that our rating with them stays the same, but they warn of a downgrade if we don't fix the load shedding problems. And while we're talking about load shedding, Mr. Jan Oberholzer of Eskom, the COO, he has resigned. His last day will be at the end of this month, the end of July. And then while we're talking about Eskom, the Minister of Electricity and the police are due to provide a report, maybe this week or next week, addressing the security issues at Eskom. And then foreign net selling of local equities year to date is now standing at 72 billion rand. It's going up very fast. And then other indicators, the manufacturing production and the gold production, both are up. Manufacturing production is up in May, year on year, 2.5%. That's a bit more than the previous month, which was 3.6%. And this marks the second consecutive month of growth in industrial activity. Gold production for May was 27%. Year on year is exactly the same as the previous month. And then mining production, it's down year on year, 0.8%. That's quite a big drop from the previous month when it was up 3.2%. It was really an unexpected drop that the analysts didn't expect that drop. And then just finally another related statistic is the bankruptcies in South Africa. The bankruptcies was last month that is of companies, 151 bankruptcies, which is normal, it's not abnormal. Normally we expect about 150 bankruptcies. The previous month was 112, but the average is about 151. So that is normal. That's all for me. Thank you, Nick.